Harry, just watch the attendee count before we start.
Got it. Good morning, everybody. We'll be getting started in 1 minute. We're just getting everybody, getting all people attending. People are still coming in, so we'll just give it another few seconds. Okay, let's get started. Good morning, everybody. Welcome to the Janover series, the third part, which is covering updates to employee retention tax credit, which is a huge area. There's a lot of talk on it and a lot of uncertainty and a lot of questions a lot of businesses have, as well as the PPP and updates on that, as well as covering some of the business tax provisions. Today, my name is Barry Sunshine, and today I'm joined with, and I'll be the moderator, and I'm joined with our panelists, Chris Zingalli, Gianluca Carrabs, and Richard Feldman. These are up and coming stars in our firm, and we'll be covering the various different topics today. This employee retention tax credit, as well as the PPP and all these business tax provisions. The purpose of all of this is to put money into the economy. And, you know, a lot of companies, these tax laws are complicated. These PPP rules and the SBA rules are very complicated. They're not widely dispersed. You can get it through newspapers, webinars, and so forth. What we feel at Janover is our clients and friends should be aware of this. There is a tremendous amount of money being injected into the economy. The purpose of this is to retain and keep small businesses afloat and big businesses afloat. And, you know, they made some of these rules retroactive. And they're talking, a new Biden plan is talking about increasing and injecting more money in the economy, because once we get, I hear today that the COVID rates have decreased in the last couple of days, which is a good sign for the economy. So once we get this COVID under control and we can resume life back to somewhat normalcy, then hopefully the economy will get that jolt that it needs. So, but until that happens, the government feels obligated to keep businesses afloat, people afloat, employed, and so forth. So they're injecting money into it. So I think these things are very, very important. And these rules are very, very, they're very, very strict. They're very, very critical. The applications of these rules are very tough. So we're here to help you guys implement these rules to get your fair share of the money, because at some point, this money has to be paid back. It's not going to be paid back in 1 year or 2 years. It's going to be paid back over a longer period of time. So if you're getting grant money, or you can have the entitled to getting grant money or credits, take advantage of it, because at some point in time, business is going to have to pay it back. But going into the rule on December 27th, this COVID stimulus bill came into law, and it substantially expanded and changed the employee retention tax credit, even retroactive to 2020. And that you can get up to $19,000 for your employee as a tax credit per employee. They also made available draw two for your PPP funding, and you can get additional funding for 2021. It's open right now. It expires in March 31st, so you have to apply and receive the money by then. The Biden plan is thinking about expanding it and extending it a little bit more beyond this round two and draw two. So, and then they're also talking about this extension of certain payroll tax deferrals, and also talking about extending unemployment extensions. So there's a lot of changes in the financial world and the economy and in all these different appropriations. So let's get started, and let's start off with a polling question. So the first polling question is this: do you think your business will qualify for the employee retention tax credit?
We'll give it about 30 seconds here, Barry. Give
Yep.
everyone a chance to respond. The 10 seconds. All right, let's close it and we'll share the results.
Okay, so it looks it's pretty parallel across the board. So about 41% said maybe I have no idea how to determine if I qualify. So you guys should be listening carefully. I've already run your analysis to qualify is about a third of the listeners, and 30% says no, I don't qualify. So my suggestion is take a look at this, and just make sure that what Luca has to say is consistent to how you've been modeling it, and making sure you can maximize your credit. So without further ado, Luca is one of our tax principals in our office. Why don't you take it away and start with the employee retention credit?
Thanks, Barry, and thanks everyone for attending. We're going to go over the ERTC. So this was, as Barry said, it was expanded and extended with this act that was passed in December. So what they did was, for 2021, they extended it through June of 2021, which means for the first and second quarter, if you meet the criteria, you are now eligible in 2021. Another really big change that came under this new law was that it's now available to those who took the PPP loans, including those borrowers from the initial PPP program in 2020. Initially, under the CARES Act, you had the choice of either taking the ERTC or taking the PPP and hopefully getting it forgiven. And I believe 100% of our clients took the PPP. So this gives taxpayers and small businesses the opportunity to go back in 2020 and analyze for potential refunds. So now these companies that receive the PPP can go back, and we're going to go through the details a little later. And so we are still waiting for guidance, which will clarify how to obtain either the ERTC for these PPP recipients in 2020 and 2021. So the rules are going to be complicated. We're still waiting to hear what the mechanics of these credits and PPP are going to, how to calculate everything. Next slide. So let's go through the mechanics of how this impacts your 2020 and 2021 calculations. The one thing to note with this new act is the 2020 credit, the actual calculations remain unchanged from the CARES Act. So if you are an employer who actually qualifies in 2020, the credit's claimed against 50% of the qualified wages paid, up to $10,000 per employee. One thing to note here is that it's capped at the $10,000 per employee annually. So for the entire 2020, you're capped at a $5,000 credit. And these are wages paid between March 13th and December 31st, 2020. And this is going to be a big difference going into the 2021 credit. So in 2021, if you do qualify, the newer law expands the credit and allows them to claim a credit against 70% of qualified wages paid. And on top of that, the wages that qualify for the credit is now $10,000 per employee per quarter for the first 2 quarters of 2021. And so this is a significant change from the CARES Act. So now an employer can claim $7,000 per quarter per employee. So that's a total of $14,000 for 2021. And what Barry threw out a number of 19,000. What he was referencing is if you can go back to 2020 and qualify for 2021, you get $19,000 of credit for both years. Barry, what is the Biden administration discussing right now about possibly expanding this to the 3rd and 4th quarter of 2021? What have you heard?
Look, there's still not negotiations between the Republicans and Democrats without getting political. The Biden plan is very lucrative. It's very juiced up. It's over $1 trillion, and they would like to extend this employee tax retention credit beyond June 30th. And you know, the numbers say a lot, because if an employee, it makes $75,000, the $14,000 credit, which is subsidized by the government, is about 20% of your wages. If you hire a $50,000 a year person and get $14,000 credit, the government's subsidizing 28%. So the purpose of this whole employee retention credit is to get people employed and get people working. So the Biden plan is just to do that, extend this employee retention tax credit beyond June 30th. It's not law yet, but it's still being negotiated. But these are very big monies going into employers' hands to get people employed.
Yeah, I think it's going to be a big boost to the small businesses who qualify. We're talking some big numbers based on the taxpayer situation. So now the employee retention credit's allowed against the employer share of Social Security taxes, and the credit is fully refundable. So if the credit exceeds the employer's total liability of the portion of Social Security in any given quarter for the 1st and 2nd quarter, or even prior, the excess is refundable to the employer. One of the things that they're discussing and they're issuing guidance on is the new law actually allows for advance payments. And Barry, something just recently came out from the IRS. Can you talk about what the most recent guidance was on this specific refundable portion and advance?
Yeah, what the IRS just recently released was the following. It was unclear to me as to how a company can qualify and get the credit in Q1. So if you had 10 employees and you were able to get a $70,000 credit for the first quarter of 2021, the question I always raised was, do you wait until after you file the payroll tax returns, which is in April? Because they're trying to inject money into the economy now. So the IRS just came out with a ruling and some guidance basically saying that you can actually reduce your deposits, your payroll tax deposits for the credit up to 70% of the Social Security taxes for the employer. The balance of it has to be refundable on Form 7200 when you file the 7200 form. So that's new guidance. And if companies are having a difficult time meeting payroll right now, this is a mechanism to put cash in the company's pockets by reducing your payroll tax deposits. Good point. And thank you, Luca.
Next slide. So this is just a quick example to see what a big impact this can have on the economy and the small businesses around who qualify. Let's assume a manufacturing company qualifies in Q1 and Q2 of 2021. They have 30 employees in both quarters, and each employee has $10,000 of qualified wages. So each quarter you have 30 employees multiplied by $7,000 credit, which is the 10,000 of wages multiplied by the 70% that they now allow. That's a potential refund in each quarter of $210,000. So that's $420,000 in the first 2 quarters. And you would consider, a manufacturing company with 30 employees, that's a small business. It's a lot of the types of clients we serve, and there's a ton of small businesses around the country who are in need of cash flow. So this is just a quick example. This has no impact on PPP. This is just if you qualify for the ERTC. Simple example to show how much cash flow a small employer can get with these credits. And so it's a big impact on the economy. Next slide. So now with the 2020 retroactive changes, especially with respect to the PPP loan recipients, this is going to create an immediate refund opportunity. So impacted employers with PPPs should begin to review how their payroll costs might be covered by both provisions in order to determine which provisions to apply. Now, those who have gone through the PPP loan forgiveness and haven't applied for it should actually look into how the PPP rules changed and how that may impact the ERTC. So with the modifications to the PPP, you can retroactively look at what non-payroll expenditures you had that might qualify for PPP forgiveness that may give rise to, let's say, a larger ERTC credit. So that's something to consider. So, another thing that happened was they created this election to not include certain wages and allocable healthcare costs in the computation of the ERTC. So what they did this to preserve those costs for PPP forgiveness. And the language in the new law actually suggests that wages are first applied to the ERTC, but it's not yet clear if how the taxpayers can elect out. We're still waiting to hear back from the IRS to see what the interaction is between the PPP and the ERTC. So it's important to note that the default is that all wages are eligible for the ERTC unless you elect out and apply those wages towards PPP first. And so, as Barry said, 2020, the retroactive ERTC credit, we're looking to hear back from the IRS and Treasury to figure out how you either file amended returns for 2020 or allow a catch up in the current year. So for the PPP borrowers that actually already applied for forgiveness, we're going to need new guidance with regard to how these decisions and elections will need to be made, because this will impact those who have already applied because of the retroactive nature, how the ERTC interplays with the PPP wages. So we need to be on a lookout for future guidance on that. And now for those, like I said, those borrowers who have not applied for the forgiveness, we really need to do a really in-depth analysis of those payroll costs and how we allocate those between ERTC and PPP. Chris, who's going to be talking a little later about PPP, he runs the group on PPP, and we've been running analysis for taxpayers. And Chris, next slide. So most employers will qualify, including tax-exempt organizations. You have to meet 2 thresholds, so 2 factors. So the first factor is a trade or business that was fully or partially suspended or had to reduce business hours due to a government order Important to note that the credit applies only to the portion of the quarter the business is suspended, not the entire quarter. So that's something to consider. The second factor is an employer should have a significant decline in year-over-year gross receipts. So what does that mean? In 2020, like I said, that the calculations haven't changed for 2020. So it's gross receipts in the calendar quarter are below 50% of gross receipts compared to the same quarter in 2019. Then they no longer become eligible in the calendar quarter immediately following their quarter gross receipts exceeding 80% compared to the same quarter in 2019. So you still can get to 80%, still qualify in that quarter, but you won't qualify in the quarter after.
So Luca, so basically to qualify retroactively to 2020, you need a 50% reduction in gross receipts from your quarter in 2020 to 2019, which is harder to achieve than 2021, which only requires a 20% reduction between your quarter in 2021 versus 2019. So a lot more businesses that sees a reduction, but not as much as 50%, they only see a 20% reduction would qualify for 2021, which is the larger credit. So, you know, a lot of companies that may not have, and we'll get into it a little bit later on, to qualify for the PPP money, you need a 25% reduction in gross receipts. So there's different percentages for the employee retention tax credit from the PPP. So that we notice in our practice is very confusing to many business owners. So good point, and just want to bring that out to everybody.
Right, and when comparing first quarter of 2021, you know, with us being, you know, at the height of this pandemic, you would think a significant amount of taxpayers and small businesses will qualify. And that's one of the reasons why they dropped it to 20%, especially comparing 2021 to 2019, when 2019 was probably a really good year for most people is what we noticed. Chris, next slide. So they put in a new election. This is just another one of the elections that needs to be considered for 2021. So the new law gives the option to elect to satisfy the gross receipts test by looking at the immediately preceding calendar quarter and comparing that quarter to the corresponding quarter in 2019. So let's assume that an employer who could not satisfy the gross receipts test in Q1 of 2021, you could make an election to compare the gross receipts of Q4 of 2020 to Q4 of 2019. And so if there's a drop there of more than 20% quarter over quarter, you will qualify in Q1 of 2021. So that's something to really consider if you know that you qualify in Q4, but don't qualify in Q1. You should consider making this election so you are an eligible employer. One thing to note, and it's important, the concept of members of a controlled or affiliated service group, it has been huge since the TCJA passed in 2017. So now if you're considered a single employer, you have to aggregate all your gross receipts and number of employees. This gets overlooked at times. The analysis is extremely complicated. The rules under the code section 448 are very cumbersome, but you know, you need to consider them to see if you qualify.
And Luca, that's a good point, because I said that right now the IRS gave you some guidance as to you can start reducing your payroll tax deposits now in February and March in anticipation of getting this credit. If you may not know your cash receipts for the first quarter 21, so you should look at your fourth quarter 2020 to see if you qualify for and make this election and qualify for Q1 of this year, so you could know for sure that you can actually take advantage of this payroll tax reduction.
Yeah, Chris, next slide. So the wages that are eligible are those that are subject to FICA taxes, as well as health expenses qualify for the credits, and they must be paid through the March 2020 to June 30th, 2021. Now, one thing to note here is that if an employee is on furlough and the employer pays for the healthcare costs, those costs are actually qualified for the credit. So when determining the qualified wages that can be included, an employee must first determine the number of full-time employees they had in 2019. So this is the 2019 average full-time equivalent calculation. In 2020, employers with more than 100 full-time employees use a different qualified wage than those with 100 or fewer. And under the new law, one thing to really consider here, the expansion here, is that the employee limit for determining which wages are applicable to the credit increases to 500. So now you're considered a small employer under the ERTC rules in 2021 if you have 500 fewer than 500 employees. So we really need to think about what is a full-time equivalent, and we have to run multiple calculations because the full-time equivalent under the PPP forgiveness is different than that of the ERTC calculation. And this is going to be very important to discuss with your payroll provider, and they can assist with these calculations, but I will say they're not always 100% accurate. They do need to be reviewed. They've gotten a lot better with them, that's for sure, but let's not assume that they're 100% correct. And we've had some clients and taxpayers who have had issues with the calculation, and they're working through it with the payroll provider. So now those who have more than 100 full-time employees in 2020 and more than 500 beginning in 2021, the only wages that qualify are those employees who are not providing services because of suspension or decline in business. And that's something that's important to note. So any wages paid for vacation, sick, or other days off on the employer's current policy cannot include those as qualified wages. So basically the employer can only use this credit on employees who are not working. Now, employers with 100 or fewer in 2020 or less than 500 in 2021, you can use all of the employee wages. So those working as well as those any time paid for not working, with the exception of paid leave provided under the Families First Coronavirus Response Act. So there's a lot of there's significant amount of interplay between different credits, PPP, et cetera. So you do have to be careful here. Next slide. So the IRS has put some guardrails in place, and I think more are going to be coming, just to keep that in mind. So the ERTC is different than the PPP forgiveness. It will reduce payroll expenses for income tax purposes. Additionally, in 2020, the CARES Act required a 30-day look-back period for determining wages that can be counted in calculating ERTC. So what they did was bonuses and raises paid after the 30-day look-back period cannot be counted. Now, under the new law, the CAA eliminates this 30-day look-back period. So if you get a raise or a bonus, if you pay out a raise or a bonus, you can count that as ERTC wages. There's no double dipping of credits. So employers who take the employee retention credit cannot take credit on those same qualified wages for the paid family and medical leave. And the WOTC credit, which is the work opportunity tax credit, you can't claim both either there. So you do have to run several different analyses to see what's best. So we're talking about PPP here, ERTC, you have interplays with the WOTC credit, and I believe more guardrails will come, but they are looking to put money into employers' pockets. Barry, I think that's all I've got. If you have anything to add.
No, thank you, Luca. I mean, these credits are very big numbers, and I mean, if you have a company of 400 people, and you can qualify for this credit of $14,000 max credit for the Q1, or $7,000 credit for Q1 and Q2. I mean, it's a $14,000 credit for the first 6 months of the year. That's a lot of money. So definitely you want to do your double checking and make sure you qualify on it. Thank you again, Luca. And we're going to be covering some updates on the Payroll Protection Program. Now I'd like to introduce Chris Chris Zingalli from our consulting and data analytics department. And but we'll start off with a polling question to begin. And the polling question is, have you applied for a second PPP draw? Yes, I don't qualify, or no for other reasons. We'll give you 30 seconds to respond, and then we'll go forward with the presentation.
All right, let's give another 5 seconds or so, and we will close the poll. You want to cover this, Barry? You want me to jump into it?
Go ahead, Chris.
All right. So it looks like 40% of people at this point said no for other reasons. We have 35% at yes, so that's great, and 25% don't qualify. For that 40%, I know some banks are still kind of tiering the process where the loans are opening. The availability, the option to submit for your second draw still are not yet to be open. So I know Bank of America, for example, is one of them that is tiering some of those openings. So hopefully you learned something here, and we're going to jump right into it. So as Barry said early on, this is the third piece of the CAA webinar series that we've been doing. We've covered PPP in a lot of detail. This is a scaled back version of what we have covered in the past, plus a couple of new items, new forgiveness items that we want to note for everybody. So in terms of second draw for PPP, obviously, I think everyone knows at this point, businesses that received a first draw can apply for a second draw. Most have already. Let's close the poll, okay? So in order to qualify for the second draw, this top point that we have on the list here is the key point here. I think it often goes overlooked. In order to qualify for the second PPP draw, the business must certify economic uncertainty makes the loan request necessary to support ongoing operations. Most of the time when people are talking about second draw eligibility, we're talking about FTE employees or revenue reductions, but we put this one first on the list because we found this to be the most important part of the second draw. Barry, I know we've talked a lot of detail about this. You want to kind of give your opinion on here? Because I know this is a really important one for us.
Yeah, I mean, I've been wrestling with this a lot because the SBA really hasn't given us much guidance on what economic uncertainty for the loan request means. Mm-hmm. They came out with a form that if you one for forgiveness, that you have to support is like playing Monday morning quarterback. Some questions are intrusive. Some questions that I would have thought that the SBA asked, they didn't. So this is at the time you submit the application that there's economic uncertainty. So if your company's doing much better now than in March of last year, or April of last year, you have to evaluate it at this point in time, and vice versa. So you really need to take a hard look at it. And even if you demonstrated it back when you did your first draw, things change now. So all of these things are part of this process. So, and it must be reviewed and properly documented.
Mm-hmm. Yeah, that's a really good point. When the first draw did come about, I think pretty much the entire planet, especially the United States, everyone could say there was economic uncertainty that made the loan necessary. Now, as things are rebounding, like Luca had mentioned and Barry had mentioned, this is a lot more important now because you have to really have a need for the money. Now, from what we've seen, only loans over $2 million for that Form 3509 are required to support this economic uncertainty certification. That doesn't go without saying that the SBA could pull any application and ask for any documentation from any lender at any time over the next couple of years. So just because they're not asking you for the 3509 because you're not you're under $2 million, it doesn't mean they're not going to require you to have to provide similar support down the road. Moving on, Other key eligibility items for PPP2, no more than 300 employees at the time of the loan application. That's across all affiliated entities. Must have experienced a decline in gross receipts of at least 25% in one calendar quarter of 2020 compared to 19. Again, you have to look at that as a group of affiliates. So it's not on a standalone basis, it's affiliated entities. You must have spent or will spend all funds from the first draw. That's I would assume almost every business kind of meets that criteria unless they really did get a loan a lot later in the process. And as of today, the deadline to apply and receive funds is March 31st of 2021. Like Barry mentioned, there are some talks of, there's talks of a potential another stimulus round. No one really knows what's going to happen yet, but at this point, March 31st is the deadline for this round. And finally, as most of us probably do know, loans are capped at $2 million, and that's $4 million for affiliated companies. So how is the loan calculated? Most people probably know this at this point, but we just want to cover a couple of the key items here. Again, loans are capped at $2 million or $4 million for affiliates. That's based on 2.5 times the average monthly payroll for either the calendar year 19, calendar year 20, or the 12-month period prior to the loan disbursement date. It's February now, so I guess the 12-month period you would take, you could take your January payroll and you could do a trailing 12, but most of the time we've been seeing our clients use calendar 19 or calendar 20. A note here for seasonal businesses, they can use average payroll for any 12-week period between February 15th of 19 through February 15th of 20. So that gives them the ability to, actually get a better bang for their buck in terms of their business seasonality. Another key item, which is a key change in this round, businesses with the NAICS code of 72, which are accommodations and food services, that's your restaurants, hotels, quick service, quick food service, stuff like that. They're eligible to have 3.5 times their average monthly payroll, which is huge, right? They're really trying to help the restaurant industry and the hotel, the accommodation industry. They've been most affected by what's been going on over the past year or so. So there is some additional help for them here. And on that note, for restaurant chains are a big one. The 300 employee limit is per physical location. So that's really important. It's not 300 across all locations, 300 per location. That's really key for the restaurant industries. Now, the next piece here that really overlaps pretty heavily with the employee retention tax credit. This becomes more important now because that employee retention tax credit is available, as Luca mentioned, to those who received a PPP loan. Before, you weren't eligible for the tax credit. You take your PPP, you go 100% payroll, you call it a day. Now that you may have to kind of play a balancing act between your PPP forgiveness in terms of what you're taking for payroll versus the employee retention tax credit, this is so much more important now. So the CAA included some retroactive changes which affect the first draw as well as the second draw. So these are all retro changes. So if you already had a first round loan and you haven't submitted your forgiveness application yet, these are all, you're eligible for these expenses. As previously, those key eligible expenses obviously include certain payroll related costs. You still have to maintain that 60% minimum of payroll spend, mortgage interest, utility payments, and rent. Those are all still the same, but now they've retroactively added 4 key categories, and I'll go through them in terms of what's most common versus what's least common. We'll touch upon this really quick. The most common here is operation expenditures. This is pretty much any software that your business uses that facilitates your operations. That's HR software, payroll software, billing software, inventory tracking software, any software that you had prior to February of 2020 and you've been paying during your covered period, all those expenses are eligible for forgiveness. This is probably the most common of these new categories, and we are finding that a lot of clients do have plenty of these expenses. So we are, in terms of balancing, the PPP payroll costs with the ERTC payroll costs, these are coming into play pretty heavily. The next most common are probably supplier costs. Those are expenditures made to the supplier of goods for the supply of goods that are essential to operations at the time the expenditure was made. So for these costs, you need to have placed an order. So you need a contract or a purchase order in effect before the covered period. So say you placed an order for some goods from a supplier in February of 2020. Pandemic happened, kind of mid-March, and you had to pay that bill during your covered period. That is eligible for forgiveness. Now, the one caveat here is if the goods are perishable, so really important for supermarkets, restaurant industry, for perishable goods, if the order was placed and paid for during the covered period, then you're fine to take it. So standard supplies, unperishable supplies, or unperishable goods, rather, the order had to have been placed before the covered period. Perishable, it could be placed during the covered period. Finally, the last two here, worker protection. So any expenditures that your business spent money on in terms of employee safety or customer safety, putting up plexiglass around the office, or getting temperature readers and stuff like that, PP&E. Finally, property damage. So any property damage related to the looting and vandalism that happened during 2020 that were not covered by insurance, you're eligible to use PPP funds on. That's probably the least common of these four. Moving on to really high level to wrap this up, to touch upon forgiveness. So the SBA and Treasury Department on January 19th did release updated forgiveness applications. And what we found out that the Draw 1 and Draw 2 forgiveness rules are pretty much the same. So the application has changed. Now the application for anyone who hasn't applied for forgiveness yet has to use the new application. But a couple of key items. FTEs are still really important. So your reference periods for the comparisons for FTEs haven't changed. So those comparison periods are January and February of 2020 or February through June of 2019. Those haven't changed. FTEs are still really important. Salary and wage reduction limit still applies. So you still have to maintain salaries, or not reduce salaries rather, of certain employees by more than 25%. The key differences here for loans before December of 2020, that reference period that you're comparing the wages to is still the first quarter of 2020. So you're comparing the average annual salary of 2020 compared to the average annual salary during your covered period. For new loans now, so anyone who's getting loans at this point for the second draw or your first draw now, that reference period is going to be the most recent full calendar quarter average salary. So that's most likely you're going to be comparing the average salary or the average hourly rate over the covered period now compared to your fourth quarter of 2020 rather than the first quarter of 2020. The application process is still largely unchanged. There are some slight changes to the application, so we put a really high-level summary down here. We have built a flow chart that kind of walks you through this process and helps you determine what application to use. But starting on the left-hand side, there's a form 3508S, which is the short form. Previously, so before the CAA was passed, that form was covering loans only under $50,000. With the passage of the CAA, this form can now be used on loans between 0 and 150,000. So up to 150,000, you could use a short form. For loans under 50K, it's important to note 50K loans are exempt from FTE reductions and salary and wage reductions. So you pretty much get a pass if you're under 50K, that if you did have an FTE reduction, you're exempt from that. However, between 50 and 150K, you still have to follow. So it's really a one-page form that the borrower fills out. And they ask you for a requested loan forgiveness amount. They just ask you for a number. They don't ask you for all the calculations that went into coming up with that amount. These instructions do specifically say for loans between 50 and 150, you still have to follow the rules for the 3508 in terms of loan forgiveness. So you still have to calculate any FTE reductions, any salary and wage reductions, and you still have to apply them to your requested loan forgiveness amount. So it's not really a pass. You're not exempt from reductions here. It's more so, the SBA is giving you a pass in terms of requiring all the documentation that you came up with to get to that FTE reduction or salary and wage reduction. They're not asking you to submit that documentation now. However, if you do put in a loan or request a loan forgiveness amount, the SBA can down the road, request that you provide support for that calculation. So you really want to be careful with this. You don't automatically want to go 100% forgiveness. You still want to do that FTE calculation, the salary and wage calculation, and you want to be sure that you really do qualify for 100% forgiveness before you go and kind of check the box here. For loans greater than 150,000, they have the ability to use the 3508 EZ, but they have to be able to certify that they had no salary and wage reduction, and they could either certify they had no reduction in FTEs from January 1st of 2020 through the end of the covered period, or that safe harbor that we've spoken about a lot in the past, that a business, pretty much a business wasn't able to operate at the same level of activity as they were at February 15th due to compliance with COVID restrictions. So if you could certify to both of those items, you could use the 3508 EZ. The 3508 EZ is a scaled back version of the 3508. You still have to put the balances in and give them information as to what you spent PPP funds on, but it is a much shorter application. Finally, for loans that don't qualify for the short or the EZ, you have to use the 3508. That's the full forgiveness form. You have to do the whole, the Schedule A worksheet, the Schedule A. It is a much longer document. Again, you still have to do all the calculations. If you're over 50,000, you still have to do all the same calculations, whether you're 75,000 or 500,000. All the calculations are the same. It just depends on what form you qualify for. Finally, regardless if you use the 3508 EZ or the 3508, if you have a loan over 2 million right now, you're probably very familiar with this, but there is a loan necessity questionnaire, the form 3509, that's required from all borrowers, in addition to the 3508 or the 3508 EZ. Now, this is the questionnaire that's kind of forcing you as the business owner to prove that the money was necessary when you applied for the loan. So as part of that, there's a business activity assessment and a liquidity assessment. You really want to make sure you take a look at this form 3509 before you submit the 3508. You want to have all your ducks in order before you start the forgiveness process. So if you have a loan over 2 million, definitely, if you haven't taken a look at the form 3509, that's definitely something you're going to want to do. And then I haven't seen much on it, but my assumption is for the loans that are capped at 2 million for the second draw, those loans are all going to be required to fill out the form 3509. So I know this could get really confusing. I know there's a lot going on here. There's a lot of different applications. Just make sure that the key takeaway here in terms of forgiveness is if you're under 150,000, it's not an automatic forgiveness as a lot of people had expected it would be early on. If you're over 50K, you still need to do all the calculations. You have to have all your supporting documentation. You don't necessarily have to provide all that documentation to the SBA, but you do have to have it. So if they come to you a year from now, 2 years from now, or if your application gets pulled by the SBA for a detailed review, you want to make sure you have all that documentation. I did hear recently that I was on a call with a client yesterday, and someone within their industry group got through their lender and their forgiveness application was with the SBA, and the SBA actually pulled them for a full audit. So the SBA stepped in. Now the SBA is reviewing every application, don't get me wrong, but this seemed to be a much more detailed analysis. The SBA stepped in and really requested a ton of information in excess of what was required of the lender as they were reviewing them for forgiveness. So you want to make sure you have all your information in order. You want to have all documentation in order, and really you don't want to cut any corners here in terms of forgiveness. Barry, anything you want to kind of wrap up with before we hand it over to Rich for the business tax provisions?
Yeah, that was a good summary, and I really liked that, and it was very informative. A couple of takeaways that I have is the following, and this is the questions that I'm being asked now. First and foremost, these loan applications are how much forgiveness you're asking for. So if you had $1 million loan and you're asking for only $100,000 of forgiveness, first check your numbers to see if that's right. But the application for the forgiveness is based on those numbers, and that's what you saw on those slides. The next thing is no matter what type of loan forgiveness that you're asking for, whether it be $1 or $5 million or in excess of that, you have to operate within the spirit of the SBA rules of these rules. Whether you're asking for $25,000 of forgiveness or much more, whether you have to submit documents or FTE calculations and so forth, you still have to operate within the spirit of the law, because if you don't, you're facing more serious issues than losing forgiveness. So those are the couple of the things that I have. And the other question, Chris, that I'm being posed is actually, what should companies be doing about filing for forgiveness? Internally, we've always said to our clients to wait until I'll say January. And the reason being is we anticipated a round two, a draw two coming out, where Congress was going to ease the forgiveness application process. And they did. So is there any rule of thumb that we take away with the timing of filing the forgiveness? Some people are saying wait till May, June. Is there any thinking about behind that?
Well, I mean, we have talked internally. It's really dependent on the business and the business owner. I guess it is key to note that the application is not actually due, and I'm putting that in air quotes. No, you really have 10 months after the end of your covered period to submit to apply for forgiveness. So there really is no rush. Every business is different, so you have to kind of look at each instance as a separate thought. You can't. I don't think there's really a blanket time where everyone should apply for forgiveness.
Yeah, I think that's right. I think the difference is banks are eager to get it off their books because those loans they'd rather have the SBA reimburse them for. And again, I would say that in 10 months after the covered period ends, that's when you have to start commencing making payments. So you'd want to file it before that period starts.
Yep.
Good point. Thank you very much, Chris. Very informative.
And Barry, really quick, just one question that we got in the Q&A. It's really quick to cover before we jump into tax provisions. But it is key to note that the first draw and the second draw loans are treated totally separate in terms of forgiveness. The key rule is you have to apply for forgiveness on the first draw before you apply for the second draw. So it's not going to be one process. It is two totally separate processes, and that is a good question. That's key to note.
Mm-hmm. Yep. Thank you.
Yep.
The next part of the seminar is business tax provisions. Richard Feldman from our office, a tax senior manager, will be covering it. And go ahead, Richard. Richard, you're on mute.
Maybe on mute.
Sorry about that. Good morning, everybody. Thank you, Barry, and thank you, everyone. I see we're running a little bit low on time, short on time, so I'm not going to spend a lot of time discussing these provisions, but we'll just go through them rather quickly. From a tax perspective, one of the more highly anticipated and prominent provisions of the Consolidated Appropriations Act, or the CAA, were the provisions dealing with the taxability of PPP loan forgiveness and the deductibility of the related deductions. So the Tax Act, the CAA Act clarifies and provides that forgiven PPP loans are not includable in a taxpayer's gross income. And that was actually in the CARES Act, but this act clarifies that. And this act also provides, which was not in the CARES Act, that business expenses paid for with forgiven PPP loan funds remain tax deductible for federal income tax purposes, Now, this overturns previously released guidance from the IRS, which disallowed those deductions. Also, it's important to point out that generally debt cancellation is included in taxable income for the borrower unless there's a specific exclusion. So usually in exchange for that exclusion, the tax code requires that there be a reduction in tax attributes. And that means a reduction in NOLs, reduction in basis of depreciable assets and tax credits. However, the Act provides that a borrower's tax basis and assets and other tax attributes, such as credits, will not be reduced as a result of PPP loan forgiveness. And finally, generally speaking, tax exempt income is an increase in basis for S corporation shareholders and partners in partnerships. However, this act provides that forgiven loan forgiveness of PPP loans is considered tax exempt income and will still increase tax basis for shareholders and of S corporations and partners and partnerships. Now, it's important to point out, though, that that basis increase only takes place when the loan is actually forgiven. So there may be situations, or there will be situations certainly, where deductions were taken using PPP loans, but the forgiveness was not in 2020, but the forgiveness was not granted until 2021. So there may be situations where there will be suspended losses on 2020 returns for shareholders and partners that do not have basis to take those deductions. Also, just want to point out that New York State and most other states have announced that they are going to follow the treatment of forgiveness of PPP income and the allowance of deductions. And this also will apply for second draws, as was previously discussed by Chris. Okay, moving on to the next slide. The other business provisions that are provided in the Act include the business meals incentives. So as most of us know, that the law generally limits the deduction for business meals to 50%. So this new act provided that businesses may take 100% deduction for business food and beverages provided by restaurants in 2021 and 2022. And this, although it's temporary, it applies to meals eaten on a restaurant's premises, as well as takeout and delivery meals provided by a restaurant. And this obviously is an incentive to generate business for the restaurant industry, similar to the provisions that Chris mentioned earlier. Also want to mention the tax treatment of EIDL, which is economic injury disaster loans, and EIDL grants and other loan repayment assistance, as well as shuttered venue grants. Basically, these are very similar to the provisions for PPP loans, which allows for the tax-free forgiveness of these grants and these loans, and the deductibility of the expenses used by these grants and loans. And also just want to mention really quickly, the TCGA, which implemented Section 163J, the business interest limitation, had imposed that those taxpayers that wanted to that those taxpayers that were treated as real property trade or businesses on the TCJA, they made basically a technical correction because under the TCJA, residential real estate was I'm sorry. They treat and then under the TCJA, real property trade or businesses that wanted to elect out of the business interest deduction, in return, they had to elect to be treated as real property trade or businesses and had to elect ADS, the alternative depreciation system. So the TCJA changed the ADS recovery period for residential rental property from 40 years to 30 years for rental property placed in service after December 31st, 2017. So it basically a technical correction. The act assigned a 30-year ADS depreciation period to residential rental property, even though it was placed in service before January 1st, 2018. Okay, just moving on really quickly to the next slide. This deals with employer taxes and credits. In addition to the employer retention tax credits, which Luca had mentioned, there are other tax credits, other payroll tax credits in this act. For employers who provide paid sick and family leave, the act extends refundable payroll tax credits provided under the Family First Coronavirus Response Act. And it extends these credits for self-employed individuals and allows them to calculate the credit based on the average reported wages for 2019 instead of 2020. So for example, an employer who pays qualified sick leave wages to an employee, and these are qualified sick wages as a result of COVID-19 for employees who either were sick or had family members that were sick and weren't able to work, and the employer was providing them sick leave wages. So they'll be able to claim a refundable tax credit on those payroll taxes corresponding to the amount of the qualified sick leave paid through March 31st, 2021. And also want to mention the employer tax credit for paid leave. That's under Section 45S. And that allows eligible employers that provide paid family and medical leave to their employees under the FMLA to claim a credit for a percentage of wages they pay to qualified employees while those employees are on family and medical leave. And that's for any family medical leave, not just related to COVID. And this was extended until December 31st, 2021. And just to reiterate what was mentioned earlier, you can't double dip on these credits. These are for credits for wages that did not qualify under the PPP or the employer retention credits. And I just want to mention really quickly that there are additional benefits for flexible spending accounts. I guess you can say they just became more flexible under the new act. I'm not going to go into those details. And just moving to the next slide really quickly, I'm not going into any of the details right now, but there are additional credits and extensions of these credits under the new act, an extension of increased charitable contribution limitations for corporations under this act, which allows 25% and 100% for disaster loans, for disaster contributions rather, under this act. And now I'm just going to turn quickly over to Barry, who's going to be our closer for today. Okay, it's all yours, Barry.
Yep, thank you. Just 2 quick seconds and then we'll complete. You know, one of the things, if you're in the entertainment business and you are looking for a PPP loan, there's another grant out there for from the SBA. It's capped at $10 million, $60 million on an affiliated basis. And instead of getting it based on salary, you can get percentages of gross revenue. So if you're in the entertainment business, you should take a look at this credit, and it's available for live venue operators, promoters, theatrical producers, and so forth. It's open there, and it's a big number, and you can catch up on past rent and everything along those lines. And in conclusion, I just want to say, everybody, thank you very much. There's a polling question, and as we wrap up right now, I just want to say to everybody, the next steps that I would be doing right now is looking at your quarterly gross receipts, determining if you're eligible for the employee retention tax credit, the PPP application. We still feel that there's going to be sufficient monies by March 31st. So I don't think there's any urgency to doing it, but I still think it's, I wouldn't delay the process, and the banks are eager to get that money on the street. Talk to anybody in our team about these tax credits and PPP. Work with your payroll processing company to try to make sure they get the credit, because that credit's claimed on the 941. So on behalf of all the speakers and all the partners and professionals of Janover, thank you very much, and have a wonderful day.